Prayesh Jain of IIFL joins in to talk about not just Maruti's concerns but the other stocks as well, the likes of Tata Motors that's facing the possibility of a strike at its UK plant. Prayesh, hi, thanks for being with us. First on Maruti, how have you reacted to that news flow about their cutting down production to align demand, and what would your call be on the stock?
Good afternoon, everyone. I think so. This is negative news coming in, especially most of us, we were expecting the recovery to happen towards the second half of FY14, and now with interest rates cuts also being delayed, possibly we might not see interest rate cuts for some time. Fuel prices rising, the demand slowdown is likely to extend even in the second half of this year. And we were estimating earlier, we had estimates of around 5% growth for Maruti. Possibly we might cut down that growth to a negative number, somewhere around -2% or flattish kind of numbers. However, for Maruti, the currency benefits are large enough for it to report a pretty strong earnings growth even in FY14, and that could be that could be a boost to earnings. And FY15, if the recovery happens, we are building around 10% kind of recovery in volumes in FY15, and if that happens, the earning growth would be anywhere between 15 to 16%, given that currency benefits might sustain, and also localization benefits might come in by that time. So in that terms, I think the Maruti earnings will see a sustained strong growth, and in that terms we have maintained our buy rating on the stock with a target price of 1750.
Okay, what about Tata Motors? They have a similar problem in terms of a production shutdown, but that one possibly because of the strike. But what are you factoring in terms of the stock? We don't really have very clear idea as to whether production would suffer at all, and if yes, to what extent. How are you gauging the situation?
See, if the strike actually happens at these JLR plants, definitely the supplies would be impacted. Currently, we're not factoring in any of these things in our estimates. The media commentary so far has been that the company will be in a position to offset any impact of that strike. But in either case, if the strike happens, the volumes will be hit, at least for a certain degree of period, and that will impact the stock price performance as well. But the larger concerns for Tata Motors is its domestic business, where CV cycle is yet to recover. We don't see that recovery happening even in FY14. Utilization levels are as low as 65-70% of the existing fleet. So the volume recovery in the CV is very bleak, and so is their passenger car business. It's been creating new lows every month. So in that terms, I think so the domestic business itself is at a big risk. JLR volumes are also expected to, the growth is expected to slow down, given that China is also witnessing some headwinds and the growth is slowing down there in China as well. So in that terms, we are building in 10% kind of growth for JLR volumes in FY14 as well as FY15. So we are not too gung-ho on the stock, and we have a market performer rating.
Okay, have you done this number crunching at all? And I don't even know if it's relevant. We understand that their credit default swaps have gone up. As well, they could have a huge FX loan exposure. Is there a likelihood of their interest costs jumping because of these reasons, now that banks will have to provide for this?
Yeah, definitely there is a case of interest rates going up, and actually the JLR business is a mix of number of currencies, and they have exposures in euro, they have exposures in dollars, there are multiple exposures. So it sometimes become difficult mathematics to work out the exact cost, but definitely there could be some negative impact on the interest cost in this quarter.
What about Bajaj Auto, Prayesh? The strike at Chakan has now entered its 15th day, but the management is sure that 95% of the production will be resumed latest by Saturday. What kind of an impact do you see on Bajaj Auto's volumes because of the strike, and what would your call be on the stock?
In the previous month, the Bajaj Auto reported that they had lost around 20,000 kind of numbers because of the strike, and if that is the kind of impact that is seen, it could be certainly pretty large in this month if the strike sustains. Because in the previous month, I think the strike was only for a period of 3 or 4 days. If that is the kind of impact, then you might see a pretty large impact coming in this month as well. The thing is, the two-wheeler side of the business possibly, could see a recovery towards the second half of FY14. Why this assumption is based on the fact that monsoons have been pretty normal, and if monsoons are normal, you might see good growth in the tractor demand, and that percolates to high agriculture income, and that eventually leads to higher rural demand, and that could possibly see in two-wheeler demand going down the road. But for Bajaj Auto, we need to track exports as well. Again, it will gain substantially on the export, on the rupee depreciation, and we'll see strong margins. Bajaj Auto, we think most of the upsides have been captured into the valuations, and we have a market performer rating on the stock, and we'll possibly maintain that.
And finally, what about your take on Mahindra & Mahindra? A slightly broader question really, if Maruti is giving such a signal about demand decline, then would you want to rethink your growth numbers for other stocks? In particular, what's your call on M&M?
See, the overall business sentiment is definitely weak. In fact, you look at the last year's trend where dieselization was happening, and diesel vehicles were outpacing the petrol variants by a huge margin. That trend has also changed in this year, and there has been marked slowdown in diesel vehicle demand, and that is likely to impact M&M, especially the competition is building up in the UV category. But nevertheless, we believe that, as again 60% of vehicles being sold in FY13 were diesel variants, we might see that evening out somewhere in the region of 45 to 50% over the medium term, and UV demand is likely to remain strong given the strong acceptance of the UV sector. But the main trigger for M&M is the tractor demand. The last quarter has been very strong for tractor demand, and after being sluggish for last 1.5 to 2 years, tractor demand is seeing some signs of revival, and if that sustains, that is a very high margin business for M&M, and if the recovery sustains, you might see a strong profit growth for M&M, and its subsidiary businesses are also doing well. So in that terms, I think so M&M is still upsides are left, and we have a buy rating on the stock with a target price of around 1135.
But then for M&M, there's still that concern about deteriorating market share, etc. in the SUV space, which is seeing so much of new competition. Just my last question to you, Prayesh. In this market which is slowing down and where there are no indications at all of any kind of recovery, even for a company like M&M, which is, like I mentioned, facing SUV threats, do you think advising any fresh buy calls is prudent, or would you just advise staying away from the sector given the fact that it's undergoing such a big slowdown?
See, this sector has been in the slow trajectory for some time now, and definitely I would agree with you that it's better to stay on the sidelines rather than invest fresh money straight away. And but if you have to pick some certain stocks in the sector for your portfolio, then definitely M&M could be one of the top bets there. And sorry, there's a